Well, hello everyone. Welcome to Trading a Smaller Account. It is, I don't want to say a fresh new week in the markets. It's a new week in the markets. What can we say, other than that? This is Trading a Smaller Account. My name is Barbara Armstrong. I am a coach and a senior manager with Charles Schwab, and I'm looking forward to the conversation we're going to have today because the VIX is high. And what does it mean when volatility is skyrocketing? It means if we can find appropriate setups, for example, trades, that there might be an opportunity to do a little bit of selling. And why might we want to sell when volatility is higher? Well, because in the world of options, that usually means premiums are higher. So it's more expensive to buy an option, but we get a higher premium when we sell. So today is going to be a day all about selling. Okay. So that's what we're up to today. If you were not following me on X, and Cameron May, who is with us in the chat today, this is a rare treat for us, but Cameron and I have worked together for a decade now. And as most of you know, I started as a client. So, I have known Cameron May since 2011. So we go a long way back. If you've got any questions, don't hesitate to ask. We are both now on both X and LinkedIn, so you can follow us on LinkedIn and on X. My handle, Barb Armstrong CS, Cameron's Cameron May CS. So, be there, be square. It's a way for you to interact with us and us to interact with you outside of webcasts like this. We're both posting, on things on the daily that we think you'll find interesting and informative. So, it's another free resource for you to take advantage of. Know that we're going to look at a lot of options trades today, and know that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We use the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to learn, to make sure you understand your strategy before you consider trading it in your live account. But there are some nuances and differences. One is that short option positions will never be assigned early in Paper Money. That can happen in a live account. And we're going to discuss that today, okay? Because it's appropriate with the positions that we're managing. We have an event actually coming up this weekend. I believe that registration for that event is closed. But if you're in that area and you show up, we'll be, happy to register you on site. I think that one is in Dallas. And then we've got Denver coming up, a 2-day event at the Gaylord Rockies, and then back to Dallas for an advanced options event at the beginning of April, and then Boston, April 17th and 18th. I believe that, I know that Ben Watson will be at all of these, and I think that Kevin Horner will be at all of these as well. I am now back here in Salt Lake City doing some personal travel, but I won't be out at another live event again until Chicago in May. But I love these events. It's how I got introduced to the world of trading. And I still enjoy them as a coach and any of you. Okay, so we're going to do a very quick market overview because there's trades, and then we've got a little bit of trade management to do that I promised that.
Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here. I'm sorry, what was that? Okay. Just getting a little instruction from the producing team here. But I'm Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading a Small Account. We're going to be taking a look at the market today. Big moves on the market. The S&P has been selling off, but showing a little bit of signs of recovery. VIX is high. What might that mean to someone who's managing a relatively small portfolio? I have an idea in mind for an example strategy that might be applied in market conditions like this. I hope that that you'll stick with me for about 30 minutes today. Let's dive into it. And of course, we've already said hello to everybody, but great to see John and Jay Richardson, Wiley, and Michael. Who else is here? Wrong. Everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. But let's get right into this webcast. First thing I want to do is have a look at the current market conditions, both from a stock perspective, but also what's going on with the pricing of options. Then we're going to be planning and placing an example trade in a smaller account in these conditions. So let's go right to the thinkorswim desktop platform. Let's see what's going on with the S&P 500. As I mentioned, we've been coming down for about a week and a half. We've even broken through possible price floors. I think there are a couple of levels that some shorter term traders may be paying attention to. There was a previous price floor right around this 6,800 level that appears to have been broken. And yet, how many of you have been keeping an eye on these two lows from back in September and December? Thaya says, no red shirt today. No, it's the blue shirt today. It may not have, some people, I think you're making a reference to the color scheming that James Boyd might select. Yeah. Don't read too far into the colors of my shirts. It's random. Anyway, but I think that there may be some short-term traders keeping an eye on these levels now, maybe down around that 65, 50 level on the S&P 500. But today's activity has been interesting as we're holding still above those support levels. What does this intraday candle look like at the moment? Might be to some looking like a bit of a hammer candle. Strong sell-off followed by a strong intraday rally, taking us all the way back up to the opening values or the opening levels of the S&P, and we're even rallying above that. Now, is that a guarantee that the sell-off's not going to continue? Of course not. But for some, they may see this as a little bit of sign of life for the bulls again. And maybe we can hold these support levels and start to rise. I'm going to put this discussion, sort of look at it through the lens of that bullish trader who sees this as showing some signs of bullish life. Maybe we're set to go back up to previous highs. Time will tell. But we're not even going to rely on that assumption for the purposes of this trade. We're actually going to set up an example trade that can theoretically benefit even if stocks just manage to not fall significantly further. All right. Well, yep, I'm stepping in. Vic, great to see you. But I want to look to see what's going on. If we've looked at what's happening from the stock perspective, just using this example index. Not everybody uses the S&P, by the way, but let's also see what's going on with options prices. When we have volatility, such as what we've seen over the last several trading sessions, that will cause a spike in demand for options, and we're seeing that on the VIX. If we flash over here to the VIX, we can see that the VIX has actually touched highs that we haven't seen in the last 10 months. And I have a little note here. What does this mean for put sellers? This is actually sort of a spoiler alert for a discussion that I'll be having in about an hour and a half from now. I'm going to be addressing my covered calls and short puts webcast. And we're going to talk about what this might imply for put sellers, but let's just talk about the implications for sellers of options in general. And that is when volatility spikes like this, it tends to spike the premiums on options. And for those that are looking to sell, what they might see is that premiums are comparatively, let's throw up the word juicy in air quotes, comparatively strong premiums. Now, there's a reason for those stronger premiums because volatility introduces risk, which can drive demand from speculators, but it also can drive demand from hedgers, just overall driving the price of options higher. So for some, they'll describe this sort of condition as a seller's market, but we have to look at that very honestly. Yes, premiums are higher, but also risk is higher. So how about what we'll do for today's example position is we're going to do a combination of bullishness. So that might align with what we see on the S&P 500. Let's say that our would-be trader here still sees price possibly rallying up, could be rallying toward previous highs, but at least potentially holding above support levels, so a bullish outlook. But we're combining that with these elevated premium levels, as we saw on the VIX. Okay, Ray is saying, why not buy a put deep in the money? Ray, yeah, there are lots of different strategies that we might consider doing under circumstances like these. Why would someone, here's my question, Ray, why would a trader choose to buy a put? Particularly one that's deep in the money, meaning it's going to be relatively expensive. They would do that if they thought that the security that they're buying that put on, let's assume it's a stock, and let's assume, that they're bearish. Yeah, their assumption there would be that they thought stock prices were likely to fall. That would actually be directly counter to the premise that I just outlined here. So for today's discussion, that would be sort of out of alignment with the premise that we've detailed. But for someone who disagrees with that premise and thinks that the markets look bearish despite this intraday rally, buying a put may be appropriate for them as long as they're comfortable with puts and the pros and the cons associated. Okay, John says straddles and strangles, but not iron condors. I know Connie Hill just wrapped up her discussions of straddles and strangles. We're not going to be doing a straddle or a strangle or an iron condor with this, but we are going to be doing a bullish trade that is structured around selling. So what might that be? Well, let's for today do a bull put spread. All right. When a trader is bullish, a couple of primary approaches: we could buy a call, that's a bullish trade, or we could sell a put. Well, buying a call, we might be buying at or near the highest levels, paying the highest prices for calls that we have seen generally in the last 10 months. So instead, maybe we switch over to selling puts, also a bullish strategy. But selling put also has capacity to allow for wiggle room in case our timing's a little bit off. So let's go find an apparent bull put trade candidate. Now, as we go look, what kind of stocks might a trader be looking for as they're looking for a bull put candidate? Well, number of potential pre-qualifiers. One big priority for a lot of options traders is the liquidity of the stock on which they're trading options, because illiquid stocks tend to have even less liquid options, and it can cause pricing issues, makes it difficult to get into and out of them efficiently. Just makes it harder to trade those kinds of illiquid options or derivatives on stocks. So liquidity, also price per share on the stock can play a role. But finally, and this, I shouldn't say finally as in this is the only three things that everybody thinks about, but a final example consideration here for today is what's happening with the chart. So let's look at a few stocks in the S&P 500. Those are among some of the most liquid stocks. We can keep an eye on what the price per share is. But let's also look through some charts and see if we can find an example trade candidate for today. So I'm going to go to my watch list over here. Let's load up the Thinkorswim. This is a public watch list that we can find just by going in alphabetical order to the S&P 500 through Thinkorswim's public watch lists. And this shows us the 500 component companies of the S&P 500. So these are among the most liquid stocks in the world. So they tend to carry among the most liquid options contracts. And what I've done here is just organize them according to their market capitalization. NVIDIA is the largest company in the world at the moment. If I click on this, this is interesting. Let's have a look at a few things that the trader might be looking to note as they're planning for a trade. Number one is there an earnings announcement between now and the intended conclusion of the trade? Not everybody tries to avoid earnings, but they can come in and kind of throw a kink in the works very quickly. Number two is, does there appear to be bullishness on the chart? Now, that's going to be different from one trader to the next. For NVIDIA, the stock has been primarily going sideways. Well, so have the markets for a long stretch. But it also seems to be holding above a support that looks like that's around the 171 level. Now, I don't believe, I'm actually not going to be taking this trade all the way to its conclusion and placing the order. I will build the order, I just won't submit it to the markets. But I don't even think we have, oh, we do have an NVIDIA position right there. And that we'll discuss in my upcoming webcast on covered calls and short puts. So maybe I'll just direct this to our IRA portfolio. There we go. And just switch this to another account where it won't be overlapping with a different position. And let's structure this example bull put spread. Let's see. James saying it's time to look for long signals, not NVIDIA. Yep, and of course, this webcast is not a promotion that we should be trading on specific securities, right? This is always just as an example of what a trader might look for as they're planning and structuring an example trade. All right, but let's just say, and this wasn't, it actually wasn't pre-planned that I was going to be trading on NVIDIA, but it happens to be the largest company in the world, among the most liquid options in the world. So we're going to see very narrow spreads between the bid and the ask price relative to other less liquid stocks. It also is interesting that it does appear to be holding that 170 support level. So I wonder, let's do a little bit of experimenting. I wonder if we could get away with selling, let's say, the 170 put and then structuring a bull put spread around that. Let's look at that 170 put first of all for maybe the March expiration. That's not very far away. I don't know how much premium is going to be left in that put. If we go to our trade tab and we open up the March expiration right here, let's go to the put side of the equation, and the 170 put, okay, it's still trading around 283 to 286. You'll notice there are only a few pennies difference between the bid price and the ask price on NVIDIA, highly liquid stock. So how about we look at selling that 170 put? So this is going to be our plan. I think what we'll do, let's see if we go for a 170, and to keep the numbers nice and round, how about we structure our put spread selling the 170 and buying the 165. So let's outline an example trade over here. And I always like to make these scratch pad notes bold so that you can see them. Our example trade for today is going to be a bull put spread. And we're going to try to size this so it might be appropriate for a smaller portfolio, because when we're dealing with contracts that are in those triple digits, those are coming with, those contracts can be comparatively expensive in a smaller portfolio. One of the potential advantages of doing a vertical spread versus doing, let's say, and maybe I'll do a quick a comparison here just to drive this point home, though, is it doesn't tie up nearly as much in cash in the portfolio, the vertical spread versus just the naked short put. So how about we do a quick comparison here? Let's say we're in, and this is in an IRA, this is just a cash account. If we were to go to that 170 put, and I were to just sell that, let's say we sell the 20th of March, 170 put, that looks like that's trading between 282 and 285. Let's say we're able to collect 283. Well, if we just did that, that would actually be a bullish trade. It would actually be a trade, a contract that we're selling at a time when contract premiums seem to be higher than at most other times in the last 10 months. So it aligns with the market outlook. We're also selling down at support. So this contract would be in good position to achieve its theoretical maximum gain as long as the stock doesn't break down below that support. Should be in good shape here. But within a cash account, especially a relatively small account, here's where the issue may arise. What we're doing is collecting a premium of 283, but in exchange, someone has the right to sell us 100 shares of stock for $170 per share. That's a $17,000 obligation. That could be chewing up most, possibly all of the available cash in a relatively small portfolio. If I were to go to place this trade, let me just do one contract just as an example. I'm going to click on that 276. Let's change that to just one contract. And if I click confirm and send, you'll notice here it's telling us we can make as much as we collect. That's the theoretical maximum profit of this trade. How much can we lose? And therefore, how much do we tie up in cash in a cash account like an IRA? About $17,000. So how can we reduce that cash commitment and really not have such a large impact on a small portfolio? That is, instead of doing just a naked put where we have an obligation to buy shares, we don't know how much we can sell them for. Let's turn this into a vertical spread. All right. So what we'll do for our example today, let's go to that 165 strike, like I mentioned. And let's say that at the same time we sell the 20th of March, the 170 put, we're going to buy the 20th of March 165 put. Now that's going to cost us a little bit of money. Looks like that might be about $1. Look at that. Might be about $1.83. Look at that. It's going to leave us with, I always like the nice round numbers when I'm teaching a concept. So here's what this does. So if we collect 283 for selling the 170 put, that gives us that obligation. We might have to buy the shares for 170. By spending $1.83 of the 283 that was collected, we now know if we need to, we have the contractual right to sell those shares. If we get stuck with shares at 170, worst case scenario, we can sell those shares along at 165. It reduces the downside exposure of the trade to just $5 per share. Instead of getting stuck with shares at 170 and who knows how much we can sell them for, we've now defined that risk at a theoretical maximum of $5. So the theoretical max loss of this trade becomes $5, but we also got paid a net credit, 283 minus 183. We got paid $1 to set ourselves up with this trade, so it actually net only leaves us with $4 of conceptual risk. So instead of, let me ask this question. Instead of about $17,000 being tied up in this trade, how much is actually going to be tied up in the vertical spread? Well, if we can define that risk at a theoretical maximum of $4 per share times 100 shares, that's only going to be tying up $400. So that's the value that this 183, just $1.83 that we're spending, really reduces the risk potential of the trade. And we'll see that if we construct and begin to submit this trade order. So I'm going to go to the 165 put. I'm going to hold down the control key on my keyboard. This is one of the ways that we can add multiple legs in our order field. And I'm going to click on the ask price to buy that put. Looks like the price has moved on us a little bit. That's okay. But this creates an order down here to buy contracts. So we're going to sell the 170 put, and at the same moment, using the same order ticket, buy the 165 put. And that looks like, let's set this, let's unlock that. So hopefully we can get a what is it going to be? Maybe a 90-cent debit or a 90-cent credit. Let's see. Let's see what we're getting here again. I'm going to minimize our order screen here for just a moment. Go back up to our option chain. Yeah, it should be, yep, it's probably more like 85 or 90 cents at this moment. The markets are open, so the prices are changing a little bit. So we'll see if we can get this filled. So somebody asked the question, Cam, can you please discuss trade management, especially what to look for to exit if the trade goes against us? Yeah, I think that's a good idea, and I think that we have the time to discuss that. So let's bring our order back up here. Oh, by the way, there's another way that we could have placed this order. Let me show you this one quick technique. We go to the 20th of March. You'll notice that these two strikes, they are two strike increments apart. We got this pesky little 167.5 in the middle. So we could change our spread up here to deep and wide. 1 month, 2 strike. And if we choose vertical there, we're telling the system, hey, I'm going to place an order where I'm trading 2 contracts. They're both in the same month, but they're 2 strikes apart. And I'm going to do a vertical spread. So if I change that to vertical and I go to that 165, 170 strike pair here, now I can just click on the bid price to create that order. Okay, let's dial this down. I'm just going to do one example contract here. There we go. Going to try to get, you know what, in the interest of time, let's say that we're willing to settle for just 82 cents. The price is changing as we speak. But to go to the question here, how might we manage the back end of this trade? Well, the trade may work out or it may not. It could work toward profitability or losses could start to mount. So let's start talking about the fun part first. And we're going to put in an order to try to take profits if they happen. We'll also put in an order to hopefully mitigate losses if they start to mount. So in order to do 2 closing orders, I'm going to come here where it says advanced order, and instead of just putting in a single order to get in, I'm going to put in this first triggers OCO. Our first order to get in is going to trigger 2 exit orders, and one of those will cancel the other, OCO. So the first entry order triggers an OCO order. So when I select that, now I can just right-click on the original order, right-click, and create an opposite for an exit order. Do that again, right-click, create an opposite for an exit order. All right, so let's visit the logic of trade management. If we're getting into a credit trade, what is the objective of the trade? Well, we want to see that trade go down in value so we can get out less expensively. But with this position, let's do some quick math here. I don't know how much we're going to pay or receive on these 2 premiums, but let's just say that between those 2, we're going to leave these blank for now because prices have changed. But it looks like we may get as little as 82 cents on our net credit. That would leave us with $4.18 of risk. So guys, this is how much we can make. This is how much we can lose. So as the trader contemplates the management of this position, they may want to try to maximize this, the 82 cents that could be made, while minimizing the $4.18 that could be lost. So here's the way we might put that into action. If we're collecting 82 cents to get in, maybe we want to spend as little of that to get out as possible. Let's set maybe a 20-cent limit to close out. When we put in 20 cents as our limit, what we're saying is, hey, I want to get into this trade for 82 cents, and I'm willing to spend up to 20 cents to close it out and be done. That would allow us to retain 62 cents, or a little bit better than 75% of the original credit received. So we're trying to get as much of that credit as possible. However, it's also likely that we can't close out at a profit. If the stock starts to misbehave, this is a bullish trade. If the stock starts to go down, it may start to cost us more and more money. Instead of being able to get out less expansively, it might cost us more to get out. So here's what the trader might do. How much is the most it might cost us? Up to $4.18 theoretically. Let's say that our trader's not interested in taking that much risk. What if they say, you know what, if I've even doubled the credit that I originally received, if the stock is misbehaving, if the trade is just not working, what if we put in a stop order here at 164? That means this trade is going the wrong direction. It's getting more expensive rather than less expensive. Stop the bleeding. I want out of this trade. That's what that means. So this is sort of back-end management. It's not the only way that every trader does it. Not every trader says, hey, I want to get at least 75% of my original credit on the profit, or I'm willing to double the credit as a calculation for maximum loss. It can be more or less than that, but I just want to show the mechanics of actually entering those orders once those decisions have been made. All right. So there we go. That'll be our example for today. So if we're weighing this for the potential impact on a small account, if we collect an 82-cent credit on one contract, and then subsequently we have to pay $1.64 to get out, we would have lost 82 cents per share if we get filled at that price. That's an assumption. A stop is not a guarantee that we'll fill at a specific price. It may be more than that. But 82 cents per share on 100 shares is an $82 loss plus commissions. Probably a total of less than $100 impact to that small portfolio that we're trying to gently manage forward. All right. So in any case, then we can just click confirm and send. This will give us a quick summary of the trade details again. There's the maximum profit that we've calculated. There's that maximum loss that we've calculated. There are reminders that there are commissions on this sort of a trade. But what we'd want to do here is just make sure that we read through, make sure that this is the sort of trade that we intended to place, selling one vertical of the 20th of March, 2026, 170, 165 put spread for 82 cents. The preference for this trade is for the stock to stay above 170. If it starts to go below 170, those losses are likely to start to mount, and it might trigger our stop. Now, we have an order in to close out for 20 cents or a stop at 164. One final reminder, that stop is not a guarantee that the 164 is the most we would pay. If we got a big gap down, might have to pay more than that. And then we just click send. I'm not going to send this one. I'm just stepping in for today's presentation, so I won't be here to follow up on this in a future webcast. But with that, though, I've accomplished what I wanted to do today. I wanted to talk through how a trader might structure a bullish trade with these higher premium conditions, but also just keeping eyes wide open to risk. Either one of these outcomes is certainly a potential outcome. So guys, it is time for me to let you go. I'm going to do this just to be completely confident. I'm going to throw the disclosures back up on the screen in case you missed those earlier in the presentation. You need to be aware that that risk is real. And any decision we make in our own self-directed account is solely or any decision you make in your own self-directed account is solely your responsibility. But we've taken a look at the markets. We've found and structured an example trade, even discussed the management of the back end of that. I hope that was a valuable discussion for you. I'm going to let you go. We have another webcast coming up in just a few minutes. And then after that, I'll be back to talk about covered calls and short puts. I hope that you'll join me then. Barb and Scott, thanks for helping out in chat. Everybody, you're certainly invited to join us on social media. First of all, make sure that you subscribe to our Trader Talks channel on YouTube if you haven't done that already. This is where you can join our live streams and you can find playlists of previous webcasts. I also would encourage you to follow Barb and me on X. You can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. Here's my X feed. And if you reply to one of my posts here, like this video that I just posted, if you reply to that post, I just try to reply right back to you. Social media is a place to connect with your favorite Schwab presenters in between the live streams. All right, everybody, I will see you again in an hour. Hope you enjoy the webcast that's coming right up. I'll look for you in future webcasts if you can't join me in an hour. I'll also look for you on social media, on X, and also on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.